Good evening and welcome. For millions, retirement represents a long-awaited chapter, a time to finally enjoy the fruits of their labor. It's a time dedicated to family, creating lasting memories and strengthening bonds with loved ones. A time for travel, exploring new destinations, and experiencing different cultures. And a time to pursue passions, hobbies, and interests that may have been set aside during working years. But a new IRS rule, slated to take effect in 2025, could significantly reshape that vision and create unexpected challenges for many Americans planning their golden years. This change fundamentally redefines what constitutes retirement income and, as a result, could have major financial consequences, potentially impacting the savings and financial stability of retirees. This also affects those who are working past the age of 65, who may find their income subject to new regulations. Therefore, understanding the implications of this shift is absolutely essential to proactively protect your financial security and ensure a comfortable and worry-free retirement. The American dream of a comfortable retirement, a cornerstone of financial planning for decades, relies heavily on careful planning, diligent saving, and a clear understanding of the financial landscape. But government regulations, with their inherent power to alter the financial landscape, can change the rules of the game overnight. The 2025 IRS rule, in particular, adds a new layer of complexity to an already intricate and often confusing system of retirement planning and taxation. We're not here to scare you or create unnecessary alarm, but rather to prepare you with the knowledge and tools you need to navigate these changes effectively. Tonight, we'll break down exactly what this new rule means for your retirement savings and income, identify who is most at risk of being negatively impacted, and provide a clear understanding of how much this rule could potentially cost you in the long run. We're talking about potentially thousands of dollars, a significant sum, enough to substantially impact your overall quality of life and financial well-being during retirement. Our primary goal is to provide clarity and empowerment, giving you the knowledge to make informed decisions so you can proactively protect what you've diligently built and saved over the course of your working life. We'll go beyond simply identifying the problem and explore practical solutions and effective strategies with valuable advice and insights from leading financial experts in the field. There are proactive strategies and actionable steps you can implement right now, even before 2025, to maintain control over your financial future and navigate these changes with confidence. Let's start by carefully examining the specifics of this new IRS rule and understanding exactly what it means for your hard-earned money and retirement savings. What is this new rule? It's called the Retirement Income Reclassification, or RIR rule. In short, it changes how the IRS views income for those over 65. Starting in 2025, the IRS will distinguish between passive retirement income, like 401k, IRA, pensions, Social Security, and active post-retirement earnings from continued work. If you have significant income from both, a new surcharge applies. The stated goal tax equity, so high earners contribute more. Critics say it penalizes older Americans who keep working. The key, if your combined income crosses a set threshold and includes both types, you'll face a higher tax bill. This isn't a change to tax rates, but an extra calculation based on your unique situation. Understanding your total income is now more important than ever. Who's affected by the 2025 rule? It targets those 65 and older, especially people who keep working while drawing retirement savings. Even fully retired people with high passive income could see changes in how their income is classified. Modest income retirees are less likely to be hit by the surcharge. Couples need to watch their combined income, as it could push them over the threshold. For example, if one spouse works and the other draws from retirement accounts, their household could face a surprise tax bill. This is a family issue, not just an individual one. How much could this cost you? Are we talking about a minor inconvenience or a substantial hit to your retirement savings? The answer, potentially thousands of dollars. This isn't just pocket change, it's real money that could be going towards your dreams and necessities. The RIR rule adds a 10% surcharge, a significant increase that can catch many retirees off guard. This surcharge applies on income above $100,000 for singles and $150,000 for couples. These are the critical thresholds to keep in mind. This applies specifically if you have both work and retirement income, a common scenario for many seniors transitioning into retirement. Let's look at an example. Susan, 67, is still working and earns $70,000 annually. On top of her salary, she also withdraws $40,000 from her IRA to cover some additional expenses. This brings her total income to $110,000, which is $10,000 over the threshold for single filers. As a result, she pays a $1,000 surcharge, a significant and unexpected expense. Now let's consider a couple, David and Maria. How does this rule affect them? David, now retired, withdraws $60,000 from his 401k to supplement their income. Maria is still working and earns $110,000 per year. Combined, their income totals $170,000, which is $20,000 over the $150,000 limit for couples. Consequently, they face a $2,000 surcharge, reducing their available retirement funds. And remember, if their income rises further, so does the penalty. For instance, at $200,000, they'd be looking at paying an extra $5,000. As you can see, the surcharge grows quickly and substantially as your income increases, creating a steeper financial burden. This represents a real financial hit, especially for those who are actively working to supplement their retirement savings. This new rule can cost you thousands of dollars that you wouldn't have had to pay before, impacting your financial stability. It's not just about the numbers on a tax form, it's about what those numbers represent in your life. It could mean delaying or foregoing your dream travel fund, those long-awaited vacations you've been planning for years. It could also impact your ability to afford necessary home repairs, ensuring your living space remains safe and comfortable. Or it could limit your capacity to help family members in need, providing crucial support to loved ones. The real danger lies in the surprise element, the unexpected hit to your finances. Many individuals won't realize they've exceeded the income threshold until they're already filing their taxes, leading to unwelcome surprises. Therefore, planning ahead and understanding the implications of this rule is absolutely crucial to avoid these penalties and protect your financial well-being. The new rule makes it more important than ever to meticulously track all of your income sources throughout the year. Keep in mind that even a one-time large withdrawal from a retirement account can be enough to trigger the surcharge, so be mindful of your withdrawals. The impact of this rule is immediate and can have a significant effect on your financial situation, so it's important to be prepared. Understanding these income thresholds is the very first step you can take to protecting your wallet and ensuring a secure financial future. As we approach the age of 65, a significant fork in the road appears. It's time to carefully consider the paths ahead. Let's compare two common paths after 65. Full retirement, where work life ceases, versus continuing to work in some capacity. Let's consider Frank, who chooses to retire fully, embracing leisure and relaxation. He begins withdrawing $80,000 from his IRA to cover his living expenses, a comfortable sum for his needs. Because he's fully retired, there's no surcharge applied to his withdrawals, just the regular income taxes he needs to account for. Now let's look at Grace. She keeps working, enjoying her profession, and earning $50,000 annually. In addition to her salary, she also withdraws $30,000 from her IRA to supplement her income and savings. Her total income from work and withdrawals remains under the threshold, so she avoids any surcharge. But what happens if both Frank and Grace suddenly need $110,000 to cover a significant unexpected expense? Frank, still fully retired, withdraws the entire amount from his IRA to meet this urgent need. Because he remains fully retired, he still faces no surcharge on the withdrawal. Grace, on the other hand, continues to earn her $50,000 salary and now needs to withdraw $60,000 from her IRA. This pushes her combined income $10,000 over the established threshold for surcharge-free withdrawals. As a result, she incurs a $1,000 surcharge on the excess amount. This penalty is triggered specifically when your combined income from both work and retirement withdrawals exceeds the set limit. This rule introduces a significant dilemma for those nearing or in retirement. Do you retire fully to avoid any potential surcharges, or do you continue working, potentially facing extra taxes on your retirement income? For many individuals, this new surcharge rule could significantly influence their decisions about when and how they choose to retire. The introduction of this rule undeniably makes the decision to work during retirement a more intricate financial calculation. It's no longer solely about the total amount of income you generate, but also critically about the sources from which that income is derived. Therefore, carefully planning your retirement withdrawals in conjunction with your work income becomes absolutely essential for minimizing tax implications. The difference in tax treatment between these two scenarios, full retirement versus working in retirement, can be quite dramatic and impactful. Ultimately, the RIR rule significantly changes the fundamental equation of retirement planning, requiring a more nuanced and strategic approach. How can you protect yourself? One powerful strategy: Roth conversions. Move money from a traditional IRA or 401k to a Roth account. Pay taxes now, but future withdrawals are tax-free. Roth withdrawals don't count as passive retirement income under the new rule. If you work past 65, you can use Roth funds without triggering the surcharge. For example, if Grace had converted some IRA funds to Roth, she could withdraw extra money without penalty. This strategy requires planning. Large conversions can bump up your tax bracket, so spread them out over several years. Consult a financial advisor to see if this fits your situation. For many, paying some tax now could save much more later. Roth conversions can be a key tool for working retirees. Take action before the rule takes effect. Another tool for those over 70 and a half, qualified charitable distributions or QCDs. Donate directly from your IRA to charity. These distributions don't count as taxable income. QCDs help you meet required minimum distributions, support causes you care about, and lower your MAGI. Example: if you're over the income threshold, donating part of your IRA distribution via QCD can bring you back under, avoiding the surcharge. It's more efficient than taking a deduction after paying tax. QCDs are especially valuable for those who already give to charity. This strategy can save you money and help others. Talk to a financial professional to see if QCDs fit your plan. Under the new rule, every dollar of income management counts. QCDs are a smart way to control your taxable income. Timing your Social Security benefits is now even more important. Taking benefits early reduces your monthly check, but waiting increases it. Social Security can be partially taxable, and those benefits count toward the RIR threshold. If you delay Social Security while working, you keep your MAGI lower and avoid the surcharge. Once you retire fully, your benefit will be higher for life. The RIR rule makes delaying Social Security a more attractive option for many. It's a trade-off. Avoid the surcharge now, maximize benefits later. Strategic timing can make a big difference in your retirement income. The new IRS RIR rule is a game changer for Americans over 65. It targets those who work while drawing retirement income, with a surcharge that can cost thousands. Understanding the difference between passive and active income is crucial. If you plan to work past 65 and draw from retirement accounts, you need to be vigilant. The income thresholds aren't high, many diligent savers could be affected, but you have options. Roth conversions, QCDs, and strategic Social Security timing. The key is to plan ahead, not react after a surprise tax bill. Review your retirement strategy now. Meet with a financial advisor who understands these new rules. Map out your income sources and make adjustments to protect your savings. Your retirement should be secure. Staying informed and proactive is the best way to ensure it. Take action today to safeguard your future.